23 seconds away from the opening bell this morning. Good morning to you. The official market start for the month of March, just around the corner. Equity futures down by a third of 1% on the S&P. On the Nasdaq, we're down about 0.2%, adding to the losses through the month of February. The opening bell in New York rings. Switch on the board and get to the bond market. A lift in yields once again, up by 4 basis points. Having another look at 4%. Your 10-year 395.72 at 4 basis points on a session. Inflation in Europe heading in the wrong direction, higher in France, in Spain, in Germany. Yields up. The euro stronger. Euro dollar 106.73, coming close to 107 again. Positive 0.9% on that currency pair. And crude lower, negative down, softer by 0.5%. 76.70 on WTI. About 20 seconds into the session, we're a bit softer on the S&P. We're down 0.2% on the Nasdaq. We're virtually unchanged. One stock to watch at the open, Rivian. The company delivering a disappointing outlook and writing in a letter to shareholders, we encountered multiple days of lost production due to supply shortages. We expect these supply challenges to persist into 23. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. Down 10% on the stock, biggest drop since November, a 2 standard deviations move. And if you look at consensus, actually hopes were really high. Many analysts were saying that they hoped Rivian would say we'll build above 60,000 units. Evercore ISI out with a note that basically points out, based on last year's conversion rate, if Rivian says it's going to build 50,000 EVs, it's unlikely to deliver anywhere near 45,000 of those. They also all point to the balance sheet, right? $12 billion left in cash equivalents and restricted cash, but based on the cash burn rate, that would be halved by the end of this year, raising questions about this company, which in November 2021 had the 6th biggest US listing in history, needing to raise even more capital. You can see there its declines across 2022, the 2nd worst performer on the Nasdaq 100. If there's a bright spot, John, and the analysts do note this, it's the belt tightening has worked. They reported an adjusted loss of $5.2 billion for last year, slightly below the guided $5.45 billion, and for this year it will be an adjusted loss, excluding some items, of $4.3 billion. This is a company I know really well. The interest in it is still super high because of who's backing it, and they are still leagues ahead from your Lucids and your Nikolas, but the street really left disappointed here.
Doesn't like the stock this morning, that's for sure. Ed, thanks for that. The stock's down by about 9%. Talked about Dan Ives then of Wedbush. This is what Dan had to say following these results on Rivian. On the one hand, Rivian is making progress and will learn from their manufacturing issues. However, time is ticking and the cash burn situation puts more pressure on the 24-25 timelines. More capital raises are not out of the question to get Rivian through this next phase of their build out and growth. That stock is getting slammed by close to 10%. I want to stick with earnings. Coles following suit with a downbeat forecast. The CEO saying the results reflect, quote, sales pressure driven by the ongoing persistent inflationary environment. Abby has more. Hey, Abby.
Hey, John. Well, the stock, interestingly, is well off of its lows right now, down about 2.7%. Earlier in the pre-market, down far more than that. In fact, down for a 5th day in a row. Over that time period, about 10%. It was a simply awful quarter. Inflation being blamed, as you just mentioned, but a massive profit miss. A loss of $2.49 versus the estimate for a gain of $1. A 5% sales miss. Comps of down 6.6% missed as well. And the outlook, it was absolutely decimated. The fiscal year profit view of $2.10 to $2.70 misses the estimate of $3.20 by as much as 30%. Gross margins of 23% missed. All of this also due to markdowns and discounting. Inventory is a little bit better. That was really the only bright spot. Not surprisingly, we have some weight here on the overall sector, the retailing sector. Macy's and Nordstrom, good comps, also down. As for Kohl's, well, this is not their first bout with trouble. This is a chart from the peak of 2018, and you can see it's down 66%. They've got their work cut out for them, and it seems as investors don't necessarily believe that they're going to succeed, John.
Abby, thanks for that. Sticking with retailers, Lowe's delivering a tepid outlook and striking a cautious tone. Following the likes of Walmart and Target, the CEO seeing a consumer more concerned with recessionary risk. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, shares have been waffling between gains and losses in pre-market trading, but now as the bell rings, seems like we're making a decisive move lower in Lowe's shares, currently off about 1.6%. 2.6% after reporting a pretty mixed bag. So let's get specific on some of those numbers. You did have revenue come in a bit light. It was a touch under $22.5 billion last quarter. The estimate there was for $22.7 billion. Adjusted EPS was actually a beat, but then you look at those same store sales. That was a disappointment, falling 1.5% versus expectations for a slight gain in the fourth quarter. What matters here, though, as you touched on, John, is that cautious guidance going forward. You have Lowe's forecasting a sales contraction this fiscal year after, as you can see, a massive boom in 2021. And this is the pandemic story that we've seen play out over and over again. You had growth pulled forward in a big way, and those companies paying the price now. So you're looking at analyst estimates there, and the consensus is that 2024 will be painful as well before a slight recovery in 2025.
Kelly, thanks for that. The stock's down by about 2.3%, about 5 minutes into the session. The broader market looks like this, down about 0.25% on the S&P, on the Nasdaq, down about 0.25% as well. Wall Street closing out a weak February. Morgan Stanley's Mike Wilson calling March a risky month. The equity market may have one last stand before we fully price the earnings downside. We think interest rates and the US dollar both need to fall for this stand to have a chance. With the market showing signs of exhaustion, March is a high-risk month. Mike, I'm pleased to say, joins us right now. Mike, great to have you with us, as always, sir. Let's start with that question. Just why is March so high risk for you?
Well, good morning, John. Yeah, I mean, normally March can be both seasonally positive or negative, but what we're seeing is this pattern over the last year where, we're in an earnings downtrend. And there's a presumption now, I think, by the market that because the economic data has been a little bit better than expected, including what we were expecting, that the earnings declines are now over. And that's not what we think. And the way the market's been trading over the last 3 or 4 quarters is, the market figures it out the month before earnings because the word kind of gets out that maybe things aren't so great in that last calendar month. And then, of course, when the companies report and the numbers actually come down, the stocks have kind of relief rally, thinking, okay, the worst is behind us. But it's been kind of this, repetitive pattern. So if that pattern holds, then March should be the month where the first quarter earnings get digested. Even though the revisions aren't coming down yet, the market gets ahead of it by about a month.
Mike, there is a concept that I hear you use and see in your research repeatedly. It's negative operating leverage. Now, Mike, for people who aren't in the equity market like you are, don't follow this stuff like maybe other people do, what does that concept mean and why is it so important right now?
I mean, it's a very simple concept. Anybody who's been doing this, for any period of time understands it, which is that, when you get positive, operating leverage is basically the leverage the company's earnings have to revenue growth. And so in the pandemic, of course, we had incredible positive operating leverage because costs were slow to come back as people were stuck at home, but the revenues came roaring back as we digitized the economy and we were able to operate. So we had this windfall profit. And we think that windfall profit was very broad. It wasn't just a few companies benefiting from COVID. It was all over the economy. And as you know, John, we've been talking about this for a while. And now, of course, we have evidence that that operating leverage is going negative, meaning we're seeing a deterioration in revenue growth, but then we're getting a much more severe decline in the earnings. And we just saw a couple of companies you mentioned in the retail space where that is being played out in spades. And that is going to happen across the economy. The evidence is already overwhelming. It's been most apparent in the tech space because that's where the overinvestment was the most egregious. And now we're seeing companies deal with that, but we think they're going to be woefully slow to get those costs down to a level where we think they need to get the margins to stabilize. So that's the thesis. It's playing out. I think some people think the worst is behind us. We think the worst is still probably ahead for most companies.
Mike, given what you've just said, from your perspective, does that mean the economy overall can be okay, but the equity market can look pretty dreadful?
That's exactly right, and that's why we have this view in our house view is that we don't expect a recession this year. I mean, we expect slower growth for sure. Close to zero real growth. But the earnings story is much worse than that. So we have this sort of weird setup where the economy looks okay, but the earnings look terrible. And by the way, it's no different than what we saw in 2020 and 21, where the economy was just starting to recover, but the earnings were explosive. So we identified that early in the, recovery back in April of 2020. We said there was going to be a very explosive, operating leverage story to the upside. And even we underestimated just how powerful that was. So what I'm a little bit worried about, to be honest, John, is that we might be even underestimating how bad the negative operating leverage could be. So we'll have to wait and see how it goes. But what we're very confident in saying is that, the margin pressure that we see has not been fully discounted in the earnings yet.
So, Mike, you clearly don't think October's the low. I won't ask for a pinpoint number, but I'm sure you can give me a range. What kind of range are you thinking about?
Well, the range isn't so important to us, John. It's more about, what happens with earnings? Okay, so if earnings come down, and we've talked about this before, if earnings come down in a way that we think is appropriate with the path that we see, and we don't get a reset on price, then we'll just say it's over, okay? So that could be here. That could be, down 5%. It could be down 20%. Our work suggests it's going to be down closer to 20% from here. So clear low 3,000s. We don't have a crystal ball, obviously, but what we can confidently say is that the equity risk premium and the multiples that are being reflected do not reflect the earnings risk that we see. And we think the reason why that's happening is twofold. Number one, the economy is better, and people were not thinking that 3 months ago. I would say the biggest shift in that regard is, 3 months ago, most institutional clients thought that a recession was very likely. Now they're thinking it's not so likely anymore. So that's a big, sea change. And then, of course, this liquidity picture that we've been writing about and talking about, where global money supply growth has been more than offsetting what the Fed has been trying to do with tightening financial conditions, and that has created sort of an ebullient environment for asset prices. That's not sustainable in our view. But the timing of that's been a little tricky.
Mike, I'm sure you get a ton of questions about the October low. Based on everything you've said, obviously we don't have a crystal ball. A lot of people would lean on market history, though. How rare would it be if October was the low?
Well, okay, let's assume a few things. Let's assume that our earnings forecast is more right than wrong, meaning that the forward estimates have not yet troughed. It would be somewhat unprecedented from a timing standpoint let's say that earnings trough sometime this summer or in the fall when we think. It would be unprecedented for the market to have bottomed that far in advance, okay? But of course we could be wrong about our earnings forecast, right? We don't, that's another thing. It's not infallible. But the odds are with us. The odds are, because our model is very much in gear. We have to go with the probabilities, and that's why we've been making the call we've been making, is that we just don't think the bear market is finished because the earnings recession is far from finished.
You said we could have one last stand. A lot of people might be gripping to that hope, Mike, that we could get another rally here. Mike, what would you need to see? And what's the chances that it's going to happen?
Yeah, well, look, we called the rally in the fall from October to December based on the following, based on the view that we thought China was going to be reopening, which it did. That would help global growth story. And rates were probably peaking, and they did. They came back down. But now that's sort of reversed, right? Rates are shooting back up because, the Fed has more work to do on inflation. And I would argue the China story, I think some of your guests were just saying, we agree with this. This is a China story. This is not a global growth story. So yes, it's very good for China equities and maybe some Asian economies that can gear off of that, but not so much the U.S. stock market, which isn't that geared to China growth. So in order for the market, for valuations to go up further, which is what we're talking about, right? In order for stocks to go higher, it has to be valuation driven because the earnings are going to be flat at best in terms of the trajectory. That means interest rates have to come back down, and the dollar has to weaken again substantially, which it's been stronger here more recently as the Fed's been it's signaling they're going to tighten further. So without those two tailwinds, I think it's almost impossible to argue for higher valuations, which means it's very difficult to argue for higher stock prices.
Mike, fantastic to get your views, as always. And as always, enjoy the research that comes out on the weekend, often starting a new week with Mike Wilson of Morgan Stanley. Mike, thank you, sir. You brought a market down about 0.2% on the S&P. Happening right now, just going to some live pictures of President Biden appointing a new Labour secretary to replace Secretary Marty Walsh. Anne-Marie back with us down at the White House. Morning, Anne-Marie.
Good morning, John. That's right. President Biden today is going to be nominating Julie Su. She's the Deputy Labor Secretary. Of course, Marty Walsh is leaving. He's going to go over to the NHL. So Biden wants to nominate this individual. She is really embraced by progressives and Democrats in the party who look at what she's done early on in her career in terms of worker protection rights, and then as well in California. But we should note this, of course, has to get confirmed at the Senate. The Democrats have control of the Senate. But when she was confirmed for her prior role, when she was deputy, it was really along party line votes. And already you're hearing from some congressional Republicans who say that her policies are, quote, destructive when it comes to the gig economy. But given that she was able to get nominated with the Democrats holding the majority in 2021, she's likely going to be seen as the next labor secretary under this administration.
MH, thanks for that. The latest with the president and his cabinet. Coming up on the program, Goldman's Investor Day. Their pitch falling flat.
In those consumer platforms, we have a plan to drive to profitability. We told our investors today we would drive to profitability in 2025.
That conversation up next.
In those consumer platforms, we have a plan to drive to profitability. We told our investors today we would drive to profitability in 2025. We likewise said that we will look at and explore and are exploring strategic alternatives to make sure that we understand all opportunities in front of us to unlock value in Platform Solutions.
Goldman Sachs holding its second annual Investor Day, the bank focusing on restoring confidence with a glossy portrait of its prospects. Investors not buying it. The unclear messaging around its consumer unit sending the stock lower. RBC's Jared Cassidy saying it's, quote, an albatross around Goldman's neck. Sonali Basak was there. Hey, Sonali.
John, it's incredible. Even when you have analysts from Wells Fargo to Bank of America seeing Goldman on path to reach its longer-term targets here, this question around the consumer business is a near-term drag on the stock. They are exploring a wide range of options. Remember, one of those options we have reported could be a sale of GreenSky, which is a business that bought for more than $2 billion a couple of years ago, agreed to buy a couple of years ago. Now, remember, that is a business in this environment that has had the drag of pressures on the consumer. And the interesting thing here, John, is so much about timing as well, because you're finally seeing, just as Goldman was the worst performer yesterday on the Dow, JP Morgan was the best performer. So you're finally seeing consumer stocks get some love back in the stock market. but a lot of questions about Goldman's execution of this business moving forward. At the end of the day, they are trying to draw out a new narrative that is Goldman 2.0, this idea that Goldman is both an institutional securities business and is making big strides in its asset manager, but consumer is still a big question.
I've got to ask you, as the man that you spoke to, the future of this company?
There are certainly a lot of questions around that. Remember, David Solomon, he spoke for 10 minutes off the bat. John Waldron spoke for another 20 minutes off the bat. David took questions at the end. There were a lot of new faces, by the way, John, this time around compared to the 2020 Investor Day. So the second ranks of Goldman Sachs, they said turnover is at a 5-year low, but the second part of their ranks look very different.
Really interesting. Hey, Shonali, just wonderful work yesterday. Brilliant. Enjoyed following your coverage of it. Thank you. Shonali Basak there over at Goldman. Tesla's turn today. Elon Musk unveiling his latest plans for the EV maker and putting the stock 70% rally to test. Ed Ludlow back with us for more. Ed, what are you looking out for today?
Well, first of all, John, the bar is very high. You look at that year-to-date stock performance, a number of analysts noting no matter what Elon Musk says and no matter how good he is at keeping investors looking to the horizon, it will take something pretty spectacular for this news to be continuing to support the stock. This is about the future over a long-term horizon, right? Tesla scaling manufacturing, but also thinking about its energy business as well. What I'm hearing from sources at Tesla is that there will be a big emphasis on supply chain. What does Tesla need to do to support that mass scaling of manufacturing on the base materials side of things? What is it doing in mining of the metals required for batteries? I remember coming on this program with you, Jonathan, 2 years ago and talking about a $25,000 Tesla for the masses, the everyday American, European, or markets in Asia. It was never forthcoming, but we do think that there will be some element of Elon Musk discussing that scaling and changing the economics of an electric vehicle's price tag so that it is more affordable for others. And of course, there's going to be an element of discussion around robo-taxi as well.
And Twitter might come up, maybe. And who knows? Ed, obviously. Ed, thank you. Looking forward to your coverage as well. Thank you, sir. You brought a equity market unchanged on the S&P, positive about 0.1% on the NASDAQ. We had some economic data out of the United States just moments ago. Mike McKee pouring over that. Morning, Mike.
Morning, John. Well, the question has been, will February come in weaker than the January numbers we got in a lot of data categories? And it looks like the first one out of the box does. The S&P manufacturing PMI for February comes in at 47.3. That's down from 47.8 for January, and that was the forecast as well. And it kind of fits with a pattern we're seeing around the world. We talked about China having a strong month, but the rest of Europe all coming in weaker for the month of February than the numbers in January. UK the only outlier there. And then this raises questions about, at the top of the hour, the ISM and what we're going to get with that, whether we're going to see a drop or not. The forecast, John, is for a move up to 48 from 47.4. We'll see if we get that far.
It's the question we all want the answer to. Was January a one-off? Will February confirm? The ISM data 8 minutes away. Mike's going to be around to break that down. Mike, thank you. I believe we can squeeze in some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Well, we have barely a move here for the S&P 500, basically flat to the downside. A couple of sectors are up largely to the upside. Energy and materials to the downside, though, really catching my eye. Real estate and utilities down almost 1%. This as yields are higher. Those dividends look less attractive. What's so interesting, though, right now, John, Kohl's has flipped to the upside. It's now up 3.6%. Let's take a look at the retailing sector on the year, because we're going to see a big move up earlier this year, up about 20% and then down about 12%. Net right now of 3.2%. I think investors trying to figure out what's going on. Telsey keeping its $35 price target in Kohl's. Maybe that's a bit of the reversal that we have on the morning.
Abby, thank you. Thanks for that on the equity market and sector price action. Abby mentioned the bond market, so let's pour through that one briefly. Up a couple of basis points at the front end on a 2-year, 4.84 on a 10-year. Keep coming close to 4, but not getting there. Your 10-year, 3.96, up 3 or 4 basis points. The 10-year, the high of the session, 3.96.11. Up next, your trading diary. Will the February economic data confirm the strength in January? In the short term, at least, I don't think anything else matters for this market. The data of the next 2 weeks is going to be really important. The next 2 or 3 weeks. Payrolls next Friday, not this Friday. Equities unchanged on the S&P, on the Nasdaq unchanged as well. About 26 minutes into the session, your bond market looks like this as well. As equities, here's fixed income yields up just a little bit by 2 basis points. Your 2-year, 483.68. That's the price action. Let's get to the trading diary. It's all about the February economic data. Look out for the ISM manufacturing number at the top of the hour. President Biden speaking again at noon Eastern. Look out for that too. Plus, Tesla's Investors Day is kicking off. Another round of claims and earnings from Macy's and Costco coming on Thursday. And finally, President Biden again, this time meeting with the German Chancellor Olaf Scholz at the White House on Friday. That gets you to the weekend. Before we get there, of course, a few more shows to go. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, March 1st. Here are the top market stories that we're following for you at this hour. It's the China bump. Manufacturing PMI surprise to the upside, setting an optimistic tone. Metals and mining stocks trading a bit higher. And a sit down with Coinbase. We're going to talk to Brian Armstrong, Coinbase CEO, on regulation, investor confidence, and more. And the right reading of eco tea leaves. ISM Manufacturing is out. We're going to talk to the man behind the numbers, Tim Fiore, chair of the ISM Manufacturing Business
Survey Committee. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And we set sort of eco data front and center, Guy, because how strong can it continue and how do we really read it and interpret it correctly in the markets?
Are the January numbers a blip? That is the key question that everybody's asking right now. Can you believe the data? Seasonal factors, warm weather, all kinds of things you can throw into that data. Does it deliver an accurate reading of what's really happening in the economy? Do we have to wait for February? Do we have to wait for March? We've got the ISM data coming through, and I have to say, not maybe what the Fed wants to see. Mike McKee, your take on this. Manufacturing comes through at 47.7. That's a little soft, but it's the prices paid number at 51.3. I thought we were going to see disinflationary trends at work here. Maybe we're not.
That is the concern, Guy. Although we did see some commodity prices rise during the month. Prices paid goes up to 51.3 from 44.5. So that's a major jump in prices. And as you mentioned, not what the Fed wants to see. Still contracting in overall manufacturing, 47.7 from 47.4, both below 50. Not a major change there. New orders do rise closer to 50 at 47 even. Production about the same, 47.3 from 48.0. And employment, 49.1 from 50.6. That's statistically not a huge change, but it'll be interesting to see manufacturing's contribution a week from Friday to the February payrolls report. And something else a lot of people have been watching, inventories. Little change there, 50.1 from 50.2. The question has been, with the manufacturing that has been going on, are we seeing companies build up stocks, or are they selling what they're producing? They're right on the line now, so it looks like not a major inventory overhang at the moment. But obviously the Fed going to be keeping an eye on those prices.
Yeah, and employment just below 50, just barely. Hey, Mike, thanks a lot. Really appreciate Bloomberg's Michael McKee. Let's get more on these numbers. We're joined now by Tim Fiore, chair of the ISM Manufacturing Business Survey Committee. Let's go through some of this here. Prices paid up over 50. Why? What's going on here?
Well, good morning. So if you're a demand and growth advocate, this is a really good report. This is our best performance number since August of last year. Especially on the demand side, you see that our new order number, rebounded, came back from a pretty low last month. Our new export order number almost passed 50. Our customer inventory number went into the high end of too low, which is good. And our backlog grew again, but it's still relatively weak. If you're an advocate of seeing a quick end to inflation, this is not a great report. As you noted, we're over 50% here, 50 points on our prices index. If you look at that, what it's really saying is that about 70% of our respondents are reporting the same or lower prices, but the other side of that is 25 to 30% of them are saying that they reported higher prices for the month. And I think Mike had it right. There's activity in the commodities market that is driving that up. The fortunate thing is it's not energy related. It's more steel and aluminum. Yeah. And I think looking into the detail of it, a lot of it has to do with capacity being managed more effectively by the participants in that sector.
Tim, good morning. It's Guy. Are those higher prices being passed on?
At the present time, it's not really clear. I think as we ended last year and came into January, there was a feeling that generally companies would be successful in continuing to pass it on. But I think what it's really saying is we've reached a level of price stability that probably isn't meeting expectations of the people who are responsible to manage inflation. Now, the manufacturing community is not responsible for managing inflation. They're responsible for growing and being profitable. So this report kind of says that, they're pushing forward. Things are feeling good. As I reported last month and the month before, we thought that half one would be a bumpy period, half two would be better. It's still pretty consistent on that. I don't think that anybody is responding that's saying that we're taking these price increases and we're taking them on our own. So from a manufacturing standpoint, it's a good report. From a inflation and an ending of this stress around what is the right price level, we're not quite there.
So we'll get to growth in just a sec. I have one more quick question on prices. If it's due to mostly steel and aluminum versus energy, steel and aluminum is going to be much more structural in many ways than, say, energy prices, which was a cyclical kind of bump. Did you get any read-through on that from companies as to how long those kind of prices would stay high?
Well, we've been growing for the last couple of months on the spot market. We're actually 50% up on the low of steel, which occurred late last year. I think it was probably September, October. We got back to about $650 a short ton on hot roll. We're now at $1,000 a ton, which is surprising because the demand really isn't tremendous. So what's causing that? Well, what's causing that is really capacity coming out so that the manufacturers can remain profitable. So the other thing is I've been reporting on the call how many industry sectors are actually contracting and how many are contracting under 45. And I think that 45 number, it's a set number by me, but anything 45 and less is concerning. So we ended the month at 80% of our industry sectors contracting, which was down from 86% back in January. But more importantly, we only had 10% contracting at 45 or less. In the month of January, we had 26%. And in the month of December, we had 36%. So it's a huge change there. And that kind of indicates to me that we're running forward. You know, manufacturing's feeling pretty good, but we haven't conquered the inflation issue.
Hey, Tim, hang on for just a second. We have some headlines here that we just want to break for you concerning Bridgewater. Bridgewater is exiting its Ray Dalio era by unveiling a lot of different things right now. A big overhaul for the world's largest hedge fund. They're going to eliminate 8% of its 1,300-person workforce. They're also going to cap the size of flagship funds to help boost some returns. We're going to get more details on this. Again, it's sort of the first big move post-Ray Dalio and some big things happening, including layoffs and capping their largest fund. We're going to get to that in just a second. Hey, Tim, when we go to the industries that are still contracting, about 10%, 45 or less, what are they?
They're the smaller guys. They're not the top 6. You know, chemicals, computers, transportation, food and beverage, and petroleum. Those are above 45. You know, some of them, I think 4 of the 6 are contracting, but they're not contracting really strongly. But we've got a trend in place here that's pretty positive. And you know, on the whole employment issue, we've had the lowest rate of quits in the month of February that we've had since we've been tracking this back in January of 2022. So it looks like employment is relatively stable. The production is being managed to make sure that they can manage absorption properly. As I said, the last couple of months, we really feel pretty good about half 2. Half 1, this report indicates that half 1 is not bad. And you know, our seasonal factor didn't do a lot to this. It actually took the number down a little bit.
Fed swaps now pricing in a peak policy rate of 5.5% in September. Tim, if we see rates continuing to rise, how's the manufacturing sector going to react?
Well, I don't know that I can really predict that, but you know, right now we've been able to manage our way through it, and I've been feeling that. I don't really feel that a strong effort will occur at the Federal Reserve, but I'm no expert at this. with this kind of a number, you know, I don't know. They're not seeing, I don't think they're seeing what they like to see. So that's kind of where we're at.
Yeah, and the market reaction is definitely telling you that. Yields jumping higher on it, equities kind of rolling over a little bit. I'm just trying to check in here on the dollar, sort of giving back some of its earlier losses. Okay, so then going forward, what's going to be the biggest thing you're looking at when we look for the March data, for example, Tim?
Well, so I'm still watching the chemicals product sector to see if it breaks 50. It improved in the month of February, but it's not about 50 yet. Transportation was our best performer, which you would expect that at, you know, think about 54, 55 or so. Petroleum and coal products did pretty well too. Machinery grew in the month. It's still contracting, but not contracting as strongly. So, you know, it's feeling like we're in a pretty good place here. You know, we're not seeing any major fall off. New export orders seem to be coming back. Europe and China were noted as improving beyond expectations. I like the fact that customer inventory is getting to the too low level again, because that means there's more output for our panelist companies to deliver to. And backlog is not contracting as fast. So, you know, everything's kind of in the right place. You just have to manage our way through this, you know, next 3 or 4 months.
Tim, one of the key questions the market's asking at the moment is the data actually a fair reflection of what's happening in the economy? I'm not talking specifically about your data, but should we believe the data? There's so many revisions, there's so many seasonal factors, there's warm weather, there's all kinds of things we've got to throw into the mix. How confident are you in what the data broadly are telling us about the economy?
Well, you know, it depends on which data it is. I think the longer it is from the source, the more suspect it might be. And, you know, where you're issuing initial information and then revising it 2 or 3 months later and it changes significantly, I get that. But that's not what we do here. And that's why on this call I talk about seasonal and non-seasonal numbers. And the non-seasonal number would have been higher than the seasonal adjustment because February is a pretty good start to the manufacturing period. Hey, so, you know, we've got 75 years of this and the panel is stable and it's done a pretty good job of predicting things. Our number's pretty good.
Hey, Tim, thanks a lot. Super appreciate Tim Fiore, chair of the ISM Manufacturing Business Survey Committee. Always good to catch up. Let's get back to those breaking headlines on Bridgewater, right? Major changes on the way at the world's largest hedge fund. Bridgewater is revamping its strategies, cutting jobs. Just 5 months after founder Ray Dalio turned over control of the firm to a management team. Bloomberg New Economy editorial director Eric Schatzker has this story. Eric, what stood out to you in terms of the changes?
Well, how much is happening and how quickly? It is only 5 months, as you mentioned, since Ray Dalio handed over control to a younger generation of leaders at Bridgewater, and they are wasting no time. Let's enumerate some of the things that are happening at Bridgewater. They're cutting some jobs, which may strike people as odd since Bridgewater has been generating, positive returns, some 10% since more or less the middle of the pandemic into 10% on an annualized basis. But what they want to do is redeploy some of those resources. They're trying to manage their business efficiently, and they have a bunch of new initiatives that they want to undertake. Very significantly, Bridgewater is capping the size of its flagship hedge fund strategy, Pure Alpha. Why? Because it has come around to believe that by limiting the capacity of the fund, or recognizing that there are capacity constraints to the strategy, it can deliver higher returns for clients. And what's so significant about that, Alex, is that for years, Bridgewater effectively defied gravity. It amassed more than $150 billion in assets, even though it was managing macro strategies. And most other macro strategies aren't anywhere near as large as Pure Alpha became.
Eric, you alluded to other strategies. Let's talk about those.
We should talk about those because they will make Bridgewater a very different firm. Right now, Bridgewater has two principal strategies. I mentioned Pure Alpha. That is its strategy that seeks excess return, or alpha, and All Weather, which is a risk parity strategy. And they have some other small stuff going. They're doubling down in sustainability. They are expanding in equities. They plan to plow a whole pile of money and talent into artificial intelligence and machine learning, Guy. And they also plan to expand their footprint in Asia, beginning with a doubling of the size of their Singapore office. They want to get closer to clients in Asia, and they want to be able to offer better products to clients who are looking for more Asian exposure. Everybody recognizes that in spite of the tensions between China and the United States, an enormous amount of the world's economy is driven by Chinese monetary policy and Chinese credit creation. And if all of those things pan out as they hope they will, each of those four things that I described will over time amass billions of dollars in assets themselves, and that will help Bridgewater by making it a more diversified firm, less reliant on those two strategies that I mentioned, Pure Alpha and All Weather.
Eric, fantastic reporting. Such an interesting story to see how they're shifting so quickly in the post-Dalio era. Eric Schatzker, Bloomberg New Economy editorial director, thank you very much indeed. Coming up, more on our question of the day. Should you trust the data? Kate Faddis, Grace Capital president and CIO, joining us next. This is Bloomberg.
Earnings season continues.
The chips are down.
Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
Feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's most valuable company.
Trending towards the higher end of its historical range.
That can continue.
How do I play this into 2023?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's much more important than whether it's 25 or 50 is what we signal in what's called the dot plot.
That was Minneapolis Fed President Neel Kashkari speaking earlier. We just got that ISM number out. You're looking at employment falling a little bit, new orders getting better, but the prices paid jumping over 50, and that obviously moving the stock market, which makes the question of the day is, do you trust this data? And the market seems to be doing it. The 10-year is now at 4%. We haven't seen that level since early November. Equities roll over, particularly those really subject to yield, like the NASDAQ 100 down 8/10. Kate Faddis, Fernwood Capital Senior Portfolio Manager, joins us now. Hey, Kate, the market believes the data today. Do you believe the data and do you trade it?
I believe the data and I do trade it. And I think most importantly, I believe the process. I think the Fed is quite earnest in what it's trying to do, which is to crush inflation. An ounce of prevention is better than a pound of cure. So that's what the Fed is trying to do. So whether they get it right this time, they get it wrong, I think they're very clear. They want to see inflation down at 2%, maybe 3%. And until they get there, they are going to do what it takes.
Grace, another way of looking at this is that while we're all focused, we've seen some very strong data since the beginning of the year, and you do wonder whether there's some seasonality in that. You do wonder whether there's some warm weather factor in that. Because inflation has remained strong, but now are we in a position where we should start thinking about a growth slowdown? Is the data masking a growth slowdown?
It's the data, I think, it's very confusing. I think it's confusing for everyone, and it's going to be very hard to know. And sure, in 10 years, we're going to look back and point out all the mistakes that were made. That's why I think it's important to understand. It's hard to believe if you look at what's going on in Europe. Look at the numbers posted in Spain, France. I think it's hard to believe that inflation is still not a problem. I'm going to focus on the data, and whatever the data says, I'm going to believe. But my instincts tell me that, look at what's going on with employment. Okay, we lost 1 million people to COVID. We have baby boomers retiring. Companies have to pay up to keep employees. So if you look at all those things, it's hard to believe. Look at the real estate market. It's hard to believe that inflation is going to go away magically.
So, Kate, does that mean that we're looking at a 2-year like at 5%? Like the theory of thought was that the 2-year was effectively priced for the Fed and the real adjustment was going to be coming on the back end. That seems to not be the case if we believe the data. It seems the adjustment's coming all across the curve. If we get to 5% on the 2-year, like what do you do? Like what works, what doesn't?
We don't, only 5%, Alex?
What do you see? So is that 6%? What does that mean?
I mean, listen, it's not out of the range of possibilities. What that means is, look, we came through an era of fear of missing out, buy on the dip, there is no alternative. Hey, if you can get 5%, 6%, I think you're going to think long and hard. You're nearing retirement, like a lot of our clients are, about do I want to expose my money into the equities market? So I think that's what it's going to be. I think equities market is going to have winners and losers, and I think more losers than winners because JP Morgan, all the banks reported they're losing deposits because people are putting it into Treasury Direct. They're putting it into the bond market.
Kate, there's a whole argument that says that the equity market is ultimately going to be supported because there's so much money sitting on the sidelines. What you're saying is that money sitting on the sidelines is a mirage. That money belongs to the bond market.
That money belongs to the bond market. I mean, another theory is the higher rates is going to pull in money from Japan and Europe. I think it's going to go into the bond market. I think you're going to think long and hard before you go into equities. Now, equities are, the equities market is not dead. The U.S. economy is still growing. It's still a great place to be. But people are going to be discerning. We want companies that are going to generate free cash flow, companies that are safe, that are going to pay dividends. I mean, gone are the days of 10 times revenue. Oh boy, I can't wait to buy this one. I think those days are over.
All right, Kate, what's your top pick then in that environment?
Okay. I like healthcare because healthcare has got long secular growth trends. Okay, Novo Nordisk. Okay, they've got this wonderful drug. It was meant for it was meant for diabetes. Now it helps obesity. That is. I spoke to my doctor about it. She said, "Kate, they're going to sell billions of Ozempic, Wegovy, because you lose 20% of your body weight." Can you imagine? I think that would be a very nice thing. I mean, and then I like the boring stocks. I like a McDonald's, even a JB Sanfilippo. If you look at Tootsie Roll, even if we do get a recession, which I don't believe we'll get, are people going to buy Tootsie Rolls? Of course they are. These are companies that are going to do well no matter what.
Kate, year to date, the European healthcare sector is the only sector that is underperforming. It is negative. Are you buying it because it hasn't performed, or are you buying it because there are structural issues here that you think ultimately will benefit it? And if so, why is the market not recognizing that right now?
The market I am buying it because of the long-term structural effects. In the end, we have an aging population, we have a sick population, we have an obese population. These things aren't going away. Healthcare is going to prevail in that environment. Market hasn't recognized it. You had tech stocks go down by a third last year. And I'm talking Google, I mean Facebook. I mean, these were big time names that went down by a third. So yes, in January, does it make sense we've had a recovery? Yes. But long term, I think the healthcare sector is the place to be.
Kate, I guess there may be a lot of societal changes that maybe point in that direction. It's going to be interesting to see when the market recognizes that and fully absorbs it. Kate, thank you very much indeed. Kate Faddis, Fernwood Capital Senior Portfolio Manager. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Baseball legend Alex Rodriguez and his business partner Mark Law want to take on Ticketmaster. They've raised a $30 million funding round for a new ticketing and fan experience business that they hope will outperform the industry's troubled incumbents. Their company is called Jump. Amongst the backers are Mastery Ventures and Drive by DraftKings. Lowe's forecast annual profit that met Wall Street estimates. The home improvement retailer took a cautious approach in the midst of shaky conditions in the housing market. Lowe's comparable sales unexpectedly fell in its most recent quarter. And shares of Kohl's are down sharply today. The department store chain reported fourth quarter sales that missed estimates. It also issued a downbeat forecast for the full year. Kohl's market value has been cut in half over the last year due to pressure from activist investors, negotiations for a sale, and changing management. And that is your latest Business Flash. Sky.
Ritika, thank you very much indeed. Alex, Kohl's feels like it's stuck in the middle. It's kind of not at the sort of non-discretionary end. The discretionary end seems to be doing well. These are the kind of stocks that get caught.
But the stock is up now, over 1%.
Yep.
So check out that reversal. Same thing with Target yesterday.
Tesla's Investors Day. We're going to talk about that next. This is Bloomberg.
right, we're about an hour into the U.S. trading session. Stocks lower. You got the 10-year at one point hitting 4%. Abigail is tracking those moves for us. Abby?
Yeah, well, Alex, take a look at this because we did into today have the S&P 500 heading to an up week after 2 down weeks. But now today we are looking at a roughly 0.4% decline. Low volume once again. This seems to be the time period of low volumes. But to Alex's points on yields, I think that this is exactly what's happening, dragging on stocks. Because we actually have the Bloomberg Dollar Index down about 3%. But take a look at what's happening for yields up and away. That 10-year yield briefly touching 4%, as Alex had mentioned. And of course, we have Fed fund future swaps, showing 5.5% a peak in September 2023. So that seems to be kicking off this movement in yield, bringing into question valuation. Let's take a look at the technicals, because the last time I looked, the S&P 500 still holding, testing that 200-day moving average. This is that sideways trend that we've been tracking. Here is the heart of the uptrend out of the October low, just touching a second time down onto that 200-day moving average. If it holds and bounces, it could be very, very positive. If it goes down once again through the 200-day moving average, well, then it's probably not going to be the same picture. Right now, this chart is probably a bit constructive, especially because there's also a golden cross there, and the 200-day moving average is starting to flatten out. As for what's beneath the surface, take a look at this. Massive moves to the upside for solar, up 12.4%. The company beat bookings, looking really quite good. Dramatic benefits of the Inflation Reduction Act. Rivian Motor, not so much, down 16.7%. Their EV production target of as many as 50,000 cars, well, that's just not making the mark. Then we also have Kohl's reversing. It had been down nearly 10% in the pre-market, now up 0.5%, and what's frankly an awful quarter, awful outlook, but maybe a kitchen sink outlook. And then finally, Lowe's also down 5.3%. The forecast for the current quarter comp sales to decline, well, investors not liking that, Alex.
No, not liking that at all. But, you know, we knew the rough housing market. Abby, thanks a lot. Really appreciate it. Abigail Doolittle joining us there. It is 31 past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts, it's what looks like a beautiful morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, I know you're probably jazzed to talk Rivian, but let's get to Tesla first. Looking ahead to the investor day today, the number one thing we need to be paying attention to.
Yeah, it's real substantive steps to increase Tesla's manufacturing scale. You know, talking to employees a few weeks ago, Musk was telling staff that it's about looking 10 years from now and saying, what is the actual installed capacity we need for both energy storage and electric vehicle manufacturing, and how do we get there? We've had some clues, of course. There's the news in the last 24 hours that coming out of Mexico that Tesla may announce a new plant, a new gigafactory for northern Mexico in Monterrey. That's coming out from AMLO, the president, and also the governor of the relevant state. So that's just one example of how they'll do it. But as you guys know, these presentations can be very detail heavy. They're like mega PowerPoints combined with like a tailgate party for Tesla's retail investors and institutional investors. And with Musk, it's kind of hard to latch on to what's kind of a near-term target versus what is there to keep investors looking to the horizon.
Yeah, so to that point, it's going to be hard for either base to ignore the Twitter question. How does that play into today?
Yeah, I guess how it plays into today is that, as you guys know, I reported that Ross Gerber, who's the CEO of Gerber Kawasaki, had made this kind of activist bid for a board seat, which he then dropped because, as I reported, Tesla agreed to meet with him around the investor day. One of the concerns that he has and was trying to drum up for support for is that Elon Musk is not focused on Tesla. He's been, very hands-on at Twitter. He spends a lot of weekends here in San Francisco working with the remaining Twitter engineers. Lots of investors want him back at Tesla doing what he's paid to do.
There was a fantastic piece out yesterday that actually he's not even interested in Twitter anymore. This is a guy that's now focused on AI. In some way, you could kind of read that back into Tesla, but maybe that's a stretch. Ed, what do you think about that? Has Elon Musk found a new shiny thing to play with?
Yeah, it's really interesting because Elon Musk was one of the sort of founding parties of OpenAI. He was an original backer. Now, based on reports, he's considering gathering great minds to form his own AI lab. That is something that he has a track record of doing, right? Jumping on whatever is vogue in the moment. He did the same around cryptocurrencies, if you'll remember, in 2021 and 2022. Handling multiple initiatives and companies is what he has done for a long time. time. But that, again, is where the investor concern lies. You know, that materializes in the stock with the key man risk discount that we saw throughout 2022.
Rivian's having a bad day. How bad are these numbers?
Bad because the stock's down the most since May of last year in a 3 standard deviations move. You know, I think they probably guided a little conservatively. Sources at Rivian were telling me that internally they discussed a range of 50 to 65,000 vehicles. 50 was very low compared to consensus, right? Analysts were hoping that they would build upward of 60,000. That said, it's double what they managed in 2022. It is a far greater ramp than Lucid as a comparator was able to do. The key point is cash burn, right? If you want to compare where Rivian is in its life cycle versus Tesla back in 2018, Tesla had similar ramp problems but didn't spend anywhere near as much cash. And there's a lot of concern about, they have $12 billion left, Guy. 12 billion is a lot of cash, but half of it should go this year.
So do the maths on this. When would they potentially have to go back and raise money?
Well, by year end, I think one note from Evercore RSI basically sees cash burn at 6 billion this year. So you go from 12 to 6. Their next factory in Georgia doesn't come online until 2026. That gives them $6 billion to get a new factory off the ground over a 2-year basis while funding their losses, right? $5.2 billion adjusted loss last year, forecast for a $4.3 billion adjusted loss excluding items this year. Those are really big numbers, but there is evidence that the belt tightening, which has included layoffs, is working. But my goodness, are they spending for growth?
Stock's just bouncing off its lows. We're down by nearly 70%. Great stuff, Ed. Looking forward to the show later. Bloomberg Technology co-anchor Ed Ludlow. Coming up, Washington scrutiny of the crypto industry. We're going to talk to Coinbase's CEO, Brian Armstrong. Going to get a take on regulation. That conversation is one that you absolutely do not want to miss. It's coming up next. This is Bloomberg.
We welcome now our Bloomberg TV viewers and radio listeners. I'm Shonali Basak, and joining me now is Brian Armstrong, Coinbase's CEO. Brian, thank you so much for joining us. You recently made this big, interesting bet as a centralized exchange on decentralization. A year or so ago, decentralization was a big worry for traditional financial players, but more so now, there are a lot of concerns about the space. So what is the case for traditional financial players to care about DeFi?
Yeah. Well, we're definitely excited about DeFi at Coinbase, and we want to make sure we help build the future of this technology here in America. Actually, a lot of traditional financial services firms are integrating this technology. I mean, everybody from JP Morgan, Visa and MasterCard, Franklin Templeton, they have projects and teams internally working on how to integrate crypto into their services. And I think the reason for that is that 80% of Americans are not happy with the current financial system as it is today. They think it's too slow, the fees are too high, it doesn't serve everybody equally, and a lot of the technology was built 40 years ago, the laws were 100 years ago, and so people are really excited about how crypto as a technology can help improve and update the financial system, and that's why we're here at Coinbase. We want to make sure that we enable that as well.
But there are still near-term challenges, and which are the biggest among them? Are they the idea of hacks and any vulnerabilities in the system, or is it the regulatory environment in the United States?
Yeah, I mean, my number one priority this year is the policy environment. So we need to make sure that that gets to a good place in the U.S. The rest of the world has actually embraced crypto. We've seen all the major financial hubs, Singapore and Hong Kong and London, and the EU just passed comprehensive crypto legislation. So really what I believe should happen in the United States is that we need a clear rule book so that this industry can be built here. We don't want it to be like 5G or semiconductors that went offshore. It's actually a matter of national security. We get the future of the financial system built here inside the United States. And so I've been spending more time in D.C., here in New York, but in D.C. in particular, we're trying to meet with the relevant folks that could help draft legislation so Congress can come in and pass comprehensive legislation.
Before we get to the Washington of it all, I want to still look out 5 years from now, because there are a lot of financial players, as you say, that are looking at tokenization. A lot of it's happening in the private markets. To the extent that you think traditional securities can be tokenized, 5 years from now, are you collaborating with any banks to get to that point?
Yeah, so crypto is many different things, right? There are crypto securities, which we believe there should be a robust market for that in the U.S. In fact, we acquired a broker-dealer license. It's still dormant right now, but we'd like to work with the SEC to activate that and create a healthy market structure to trade crypto securities. Now, of the 1,000 assets we've looked at Coinbase, 800 of them we've rejected. We don't think we have, maybe they're securities. 200 or so of them we have listed on our platform. We believe those are commodities. And so we're going to continue to build that piece of our business. We're regulated by the CFTC, for instance, and make sure we grow that piece as well. But crypto is many things. It's commodities, it's securities, it's stable coins, it's artwork, it's decentralized identity systems. And so it's tough for people to wrap their head around, but it's ultimately going to have many different regulators.
Before we get to the regulatory part of this, too, we were talking kind of about traditional financial players and what role they have in this system. What kind of relationship do you have to high-frequency trading firms? Prior to the implosion of FTX, you saw them working, for example, with IEX. Have you had any conversations with them or any others?
Well, we're always talking with different firms out there and other exchanges that may want to trade crypto in various ways. We can act as a brokerage, an exchange, a custodian. We can play different roles in different market structures. And in financial services, you often see, a company that may compete on one product, they're actually collaborators on another product. And so we want to make sure that we're helping integrate crypto into all aspects of the financial system so we can update the financial system.
So you were talking about the SEC, the CFTC, the SEC's crackdowns as of late in particular. You work with a lot of institutions. Hedge funds had been very much getting into crypto prior to last year. I'm wondering if the SEC's crackdown is starting to scare any of them away.
Well, in a way, actually, I think Coinbase has been a net beneficiary of this because there's essentially a flight to quality. Coinbase, we're a public company. We have audited financial statements. We're a qualified custodian. I mean, we're basically the choice, based here in the U.S. that hedge funds are going to want to work with. And so in Q4, I mentioned this on our earnings call, actually, that we saw an increase in the number of institutions onboarding to Coinbase. Now, a lot of them haven't deployed substantial capital to crypto yet in this market environment. They're kind of waiting and seeing. But but it's great to see them onboarding, and that's kind of a coiled spring that I think could unleash a lot of potential in the next market change.
Hedge funds still flocking to crypto. Listen, we are resetting here just really quickly here with Brian Armstrong, the CEO of Coinbase, for our Bloomberg television and radio listeners. Getting into the complicated regulatory environment now. Stablecoins. You were talking about how there are multiple regulators for the crypto industry, but who should be the primary regulator for stablecoins? And is there a case for them to be overseen more like money market funds?
Well, I think Congress ultimately is the one that's going to create the laws in the United States, right? And so we could probably use new legislation, new laws around how stablecoins should be regulated. I don't presume to tell them how to do that, but I think some of the key things are uncontroversial. I mean, we need to have one-to-one backing of assets behind these stablecoins. We need to have audited financial statements to make sure the firms issuing these are doing a good job. So these are just kind of basic good practices, and I think a stablecoin bill is one of the first things that could really help get consensus and move things forward in D.C.
To the extent you still have concerns around the stablecoin industry, what would they be?
I mean, as broadly as a concept, I don't have concerns about it. There may be individual stablecoins which are better or worse. I mean, we actually recently delisted, BUSD as an example, and the reason we did that was, Paxos had gotten, who's the issuer of BUSD, had been kind of ordered to stop minting it. So we were concerned about liquidity issues for our customers. But we're always evaluating through our internal processes different stablecoins, different assets, and updating when we see new information that comes to light.
I'm curious about your own way of using stablecoins. Recently in the fourth quarter, it showed that in your filings, it showed that USDC has doubled in your holdings prior to the quarter before. Why is that the case?
Well, okay, so USDC is growing quite a lot, and I think actually USDC is it's the best answer to a stablecoin in the United States, right? It's issued by Circle, which is a U.S.-based company. We're in partnership with them, and we want to see that grow. It's also been a really nice source of subscription and services revenue for us, which is, in contrast to trading fees, which are quite volatile. We've seen in our Q4 earnings that our subscription and services revenue is now 47% of Coinbase's revenue, almost half. And so that's allowing us to build a more predictable business with a diversified set of revenue streams. So, yeah, I'm quite bullish on USD Coin, and I feel like that's a good solution for the U.S.
Does that look a lot more like traditional banking?
Not necessarily, no. I mean, in traditional, there's many differences. In traditional banking, there's fractional reserve, they have banking licenses, there's capital requirements. Everything in USD Coin is backed 100%. There's no fractional reserve. So I think of USD Coin as a really important tool to help payments be more efficient globally. It's helping provide, access to, something like a bank account, but it could be self-custodial for many people around the world who don't have access to a stable currency. It can improve even, a lot of DeFi, which you mentioned at the beginning, the trading pairs are denominated in USD Coin. So these are all good things which are an important part of the ecosystem.
So let's move to the staking part of the business here, because you have been concerned, you've voiced concerns, you and your colleagues, about the SEC's definition of staking and how they've approached staking. Are you prepared to fight the SEC at any front if you need to when it comes to the staking world?
Yeah, so, I mean, we recently saw there was a settlement with Kraken, that's another exchange out there, and they have what they called a staking product. It was kind of more of a yield product. But, in Coinbase's case, our staking product is not a security. There's many differences. I mean, customers never turn over their assets to Coinbase, for instance. They're always in the customer's possession, and we're really just providing a service that passes through those coins to help them, participate in staking, which is a decentralized protocol. So that's an important part of, the crypto economy that we want to make sure that we ensure that that's out there. And, we're prepared to defend that in court if we need to, but we're never looking for a fight. We want to work collaboratively with regulators all over the world, but we have to follow rule of law, and in this case, I think we're well within the law.
Given the stance the SEC has been taking regarding defining certain assets as securities, is there anything that you think will need to get to that point?
Mm-hmm. Well, the SEC has expressed their view about what is a security, and they've taken kind of an expansive view of that. Coinbase, we've evaluated over 1,000 different assets, and as I mentioned earlier, 800 of them we've rejected, and we do think they have some properties of being a security, so we don't trade those today. Another 200 or so of them we do trade today, and we feel that those are commodities. So, look, I think as a CEO, we want to basically just have a clear rule book, right? And if a clear rules are published, we're happy to follow it. And if those rules change, we're happy to follow those. But I think, when we became a public company, we explained to the SEC in our S1 filing and in dozens of meetings that we've had with the SEC, I think we work pretty collaboratively with them. We've explained our business to them many times, including in our S1, and they approved us to become a public company. So we'll continue working with regulators all over the world about where the boundaries are on what's a commodity, what's a security, or what is something else.
Resetting once more for our Bloomberg radio and television audiences in conversation with Coinbase CEO Brian Armstrong. We're talking about the SEC and state regulators as well. In regulatory filings, you've noted that you received investigative subpoenas from the SEC and state regulators. How and when do you get those resolved?
Yeah, well, subpoenas are really just requests for information, right? And so we're in dialogue with regulators not only here in the U.S. at the state and federal level, but really around the world. I mean, we're in European markets and, in Singapore and in Australia, et cetera, Canada, many different markets around the world. So I think subpoenas are an important part of the process. That's them asking us a question and saying, we'd like more information on this, and we're happy to do that.
It sounds like there was a tension between the SEC and the industry before. It sounds like some of those tensions have boiled up after FTX. I'm wondering if you think that the conversations between Coinbase and the SEC in particular have gotten more or less contentious over the years.
I think we have a good relationship with the SEC commissioners and staff, and I've met with the chair as well, and so we're going to continue to invest in those relationships. I would like us to find a way to bring crypto. I think this is what they want too. Our interests are aligned. We want to bring this industry within the regulatory perimeter so that we have good consumer protection, but we also preserve the innovation potential of this. And as I said earlier, 80% of Americans want the financial system to be updated, and this is the most important technology I'm aware of that can help do that.
So you and your colleagues have also voiced a lot of concerns. Today you voiced concerns about kind of more of the crypto industry moving offshore. Mm-hmm. Draw us a picture here of what happens in 5, 10, 20 years if the digital asset landscape exists mostly outside of the United States.
Yeah.
In exchanges that are not based here.
Yeah. Well, I mean, look, I think that would be a terrible mistake for the United States. I mean, look at what's happening with AI, right? That's an important technology trend where it's becoming a matter of national security, right? That some of these things are built in the U.S. Or we saw it in the past with 5G or with semiconductors. And so if we have this really powerful technology, cryptocurrency, that has the potential to update the financial system and improve it in so many ways, how can we sit on the sidelines in America and say, oh, okay, well, we're going to let, the EU pass comprehensive legislation, and so it'll be built there, and we're going to let the UAE and, London and Singapore and Hong Kong. I mean, this is America. We need to be a technology hub. We need to be a financial hub. And the future of this industry needs to be built right here in America.
Brian, thank you so much for your time. That is Brian Armstrong. He is the CEO of Coinbase. Back to you.
Sonali, fantastic. Thank you very much indeed. Bloomberg Sonali Basak in conversation with Brian Armstrong, Coinbase's CEO. This is Bloomberg.
European stocks 34 minutes away, 35 minutes away from the close, and they are down. We're trading sub 460, 459.59. We're down by 0.3%. The London market is outperforming, or more specifically, the mining stocks are having a better day, names like Rio Tinto. The China data on the manufacturing front was good. We'll talk about that in the next hour. London outperforms, the rest of the space doesn't. You are seeing commercial property under quite a bit of pressure today. The German 2-year, let's talk about the main event of the day out of Europe. Stronger than anticipated German inflation, hot on the heels of stronger than anticipated inflation data out of France and Spain. Remember, we get the main event tomorrow with the Eurozone data. We're going to hear from the head of the Bundesbank in just a moment. We're up by 7 basis points. The euro is catching a bid. More broadly, though, we are seeing some dollar weakness today across the piece. So euro dollar now trading 106.68. We're up by 0.9%. The only bond market that is actually in the green today is the gilt market. Andrew Bailey, the governor, was making some comments earlier on, in some ways affirming current market pricing. We're going to talk about all of this in the next hour. Barno Buwaisha is going to be joining us, chief strategist over at UBS. Always worth listening to. That conversation coming up. This is Bloomberg. Wednesday, the 1st of March. Yes, it is March, but the markets are not on the march. Take a look at what is happening with equities today. We are doing nothing because the action is elsewhere. It's in the bond market, it's in the currency market. There are a few sectors that are certainly on the march today. We'll deal with the details of those in just a moment. But today was once again about inflation. That is the narrative that is really the story here in Europe. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So here we go. Equities are down. We're down by 0.4%. That's the Stoxx 600. The London market is outperforming because mining stocks are having a slightly better day today on the back of the Chinese manufacturing PMI. The UK 2-year, one of the few bond markets around Europe today to be catching a bid. The reason for that, in some ways, Andrew Bailey kind of confirming market pricing, but basically being reasonably agnostic on where rates go next. That is what is happening at the front end of the UK curve. Is the UK housing market teetering on the brink? There's certainly a margin concern around Persimmon, one of the UK's largest house builders, out with numbers a little bit earlier on. The margin story really stuck out. That stock, Alex, being absolutely battered today, down by 9.4%.
Yeah, those numbers were not good. Okay, here in the U.S., there's a couple different threads that we can pull at. So first, you get the overall macro. S&P is down by 0.3. Now, part of that is going to be the ISM data. We really went to the lows of the session on that. So ISM manufacturing coming in not bad, but it was really the prices paid that jumped over 50. The overall index, we haven't seen that strength since August. So both of those coming in and kind of weighing on the S&P, because guess what? Then the Fed's going to have to do more. So that's one narrative. The other narrative is China. Their manufacturing PMI is coming in very strong, and you can see that reflected in the metals and mining sector, up over 2%. Freeport, second best performing stock on the S&P. First Solar also, although that could be on earnings and lower costs. Then you dig even deeper, and the worst performing stock on the S&P is Lowe's. That's an earnings story. Shocker. They're looking for the first quarter comp sales to be kind of dicey. That feels like a Persimmons kind of read-through as well. We know housing is weak. Now back to the macro, the 10-year yield at one point hit 4%. We haven't seen that level since November 10th, and that is on the idea that hot inflation not coming down, prices paid higher in the ISM. That means the Fed's going to have to do more. I feel like that's a similar theme macro on both sides of the Atlantic, Guy.
Yeah, and more evidence today to really kind of confirm that narrative. The question we're asking today in this hour is, are the hawks right? Well, today's data out of Germany, just adding to the number we saw out of Spain yesterday, 6.1, adding to the number out of France, 7.2. Germany comes through at 9.3. This is the bit you want to pay attention to. There was this expectation that inflation was going to be rolling over. There's now signs that it's reaccelerating again. Now, to reference back to the data we saw in the last hour, Alex, can we believe this data? Is this more to do with other factors? Is this to do with seasonality? Is it to do with what is happening with lower gas prices? What is going on here? I think it is a very confusing picture.
Yeah, and it felt like part of the narrative was that we were definitely have already priced in hotter data, right? But then we haven't, because right after the headline inflation hit, you saw the ECB terminal rate fully priced at 4% and continuing to rise through February 2024. That doesn't tell me that the market is fully priced for continued hot data, and that's also where it feels really confusing.
I think it is just really confusing. I think it may take a little while to figure out exactly where we are. But I have to say, the president of the Bundesbank now thinks that the market is catching up to the ECB, i.e. we're now starting to price a more realistic reflection of ultimately how much heavy lifting the ECB may ultimately have to do. The Bundesbank president, of course, Joachim Nagel, talking earlier on today, talking about the challenge basically of getting inflation back to that 2% target. He was at the Bundesbank event a little bit earlier on. Also there, Bloomberg European correspondent Maria today, they had a fascinating conversation. Take a listen.
It seems to be the case that inflation is very stubborn. And that is bringing me to the point that monetary policy has to be more stubborn than the inflation. So it looks like, and it's clear for me, that what we have to do for the March meeting of the Governing Council of the Eurosystem, and also beyond this meeting, I think there's more necessary. This is the main message I take from the high inflation numbers.
And when you say in March, essentially you know very well the idea is a continuation of 50 basis points. I wonder if you would push back against that. And when it comes to the sequencing going forward, because a lot of what happens in March, it's already understood to some extent what that meeting will bring. But you talk about significant going forward. I wonder in the sequencing, how do you picture that?
I think it's not fair to speculate what is the sequencing beyond March, but it looks like for the moment that 50 basis points for the March meeting, very necessary. And then beyond the March meeting, we have to wait the data for our March meeting. But it looks like what I see on the inflation side, that the inflation outlook might be on a too high level for the period, for the months after our March meeting. So it looks like what I just alluded to, that 50 basis points for the March meeting, yes, and then we will see. But I believe that significant rate hikes beyond March are necessary.
And you say no active bond selling, but what about an early end to the PEP reinvestments? Is that something that you feel at least merits now a serious conversation?
Maybe not. I don't want to speculate about the PEP. What I guess is necessary that we took the decision in our last meeting to start the reduction of our asset holdings in the APP, 15 billion every month. I believe that could be more or less, there's a good way to get this into the market. The market will understand why this is necessary. But I believe beyond that, from July on, we need more than 15 billion each month. We can do maybe 20. I think this is one of the things that I believe is of utmost importance. And then later on, maybe next year, we can talk about the PEP.
Bundesbank President Jochen Nagel speaking a little earlier in Frankfurt to Bloomberg's Maria Tadeo, not mincing his words. So our question of the day, given the data we've seen over the last couple of sessions, are the hawks right? Have they nailed this one? Well, let's talk about this. Our Western European economy editor, Zoe Schneeweiss, joining us on set, as is UBS chief strategist, Barney Bewasia. Nice to see you both. Zoe, basically the question is Nagel and Schnabel, are they nailing it? Are they getting it right? And Lane getting it wrong? Is that how we should think about it? Because the data just keep coming in on the Hawks side. Have the Hawks got it right?
It certainly would seem that way. The data just back to back now have confirmed what the Hawks are saying, that the ECB will have to do a lot more. They've already said they're going to do another 50 in March. Now some banks have changed their calls and expecting another 50 in May, where before everyone had said 25. And as we know yesterday, markets now pricing that the ECB will go to 4% on the deposit rate. That's quite a stretch. The data would certainly support that, and we're getting the actual headline, the euro area, the number for the region tomorrow, and that will be, I think, a very important sign.
Barney, give me your considered opinion on this.
So look, I mean, I think Zoe is absolutely right. Tomorrow's number is big. If we get core close to 5.5, then there's a pretty decent chance that May gets priced for 50 as well. So you start looking at 4% rates in the Eurozone as well. And I think we should pay attention to the difference between inflation in the US and Eurozone. Not that US inflation is coming down in a big way. Headline inflation is, but core inflation was elevated. But I think it would be a mistake just to think about European inflation as lagging US inflation. Remember that European real wages were deeply negative, much more so than the US, and which means that negotiated wages could be higher for a while. And that means that even though you could get headline inflation coming off hard in Europe, core inflation may not come down. And so the time you can get back to 2% inflation sustainably could be 2025, right?
Oh, wow.
So that is a problem for the Eurozone. I think that's being reasonably priced in the strip, in Esther. I don't think that's being priced in the equity market. I don't think the equity market's paying attention to the fact that it's not just an energy problem that Europe has, but it's also a tightening problem, and I think that's not priced in equities at all.
Well, Zoe, pick up on that, because if we see a better chance for a wage price spiral in Europe versus the U.S., what is the ECB going to do about that?
The ECB has said quite clearly that inflation is their main concern. They're really very worried that inflation expectations will be priced higher and higher, and that's why they started hiking rates when they did. Again, just as a reminder, it takes about 18 months for ECB rates to actually feed through. So they are not fighting the actual inflation rates we have now. They are fighting to make sure that inflation expectations don't get raised too high. So it's one of those, they want to do everything they can to stop this, and as we know, 4% would be unprecedented. Let's see if they actually get there.
You know, what's fascinating is just very quickly, 5-year inflation swaps in Europe are at the same level as the US for the first time since 2008. And in 2008, it was just the volatility around GFC. But basically, you've never seen long-end inflation expectations in Europe converge onto the US, and that's already happened. And so the ECB, as Zoe says, has a serious problem in managing inflation expectations. It's not about headline. It is about broader inflation core. It's about inflation expectations. So I think they're going to have to be hawkish for a bit.
I was in Luxembourg yesterday morning talking to Peter Pratt and a whole load of other kind of very senior economists out of Europe, and they were joking, look, the new normal is 4-6, 6-4. US goes to 6, ECB goes to 4. Could that spread be actually tighter, given what you're saying?
It's possible for a while at least, because I think the US labor market, the labor market in the US is also, at this point, is showing behavior that it hasn't shown in the past. There's hoarding and so on, but I think that market is lagging and it's going to catch down in a big way in terms of non-farm payroll employment, but also in terms of wages. So there will be a spell where US is going through core disinflation well before Europe is going through core disinflation. So I don't know if the Fed is immediately going to respond. So through 2024, you can see the Fed moving very quickly, but the ECB is going to lag, and not just by 3 or 6 months. The ECB is going to lag by more, which has implications for the currency, but it also has implications for the relative performance in the equity markets. And again, that's where I think we're not pricing it.
It was interesting, actually. I was talking to a governing council member, and he was talking about the fact that you could actually see headline and core flip, i.e. core remains above, more elevated than headline. Mm-hmm. What's happening to growth underlying all of this, though?
So growth, I mean, that's the tightening is the freight train, right? And here you have to think about the U.S. You are seeing C&I loans, so commercial and industrial loans, coming off. You are seeing excess savings being burnt off, and by September, these excess savings could be zero. Credit card balances are picking up, revolving facilities are picking up. So clearly there is a slowdown. In the first couple of months of the year, we've seen data which has been very hot in terms of retail sales, in terms of core PCE. I think what lies ahead is actually inflation comes down slowly, but the data does come off, right? So in Q2, we're expecting those numbers to come off. I'm not thinking that this is the beginning of another cycle. By the way, the markets are not anywhere close to pricing in recession. Nowhere close. Not the equity market, not the fixed income market.
Just before we go here, and we'll come back and talk more about what that means for the equity market, but Banu, what happens into the UK? Because Andrew Bailey was talking today, and it did seem like the market took that as a more dovish statement. He says if we do too little now, we're going to have to do more later. You know, he talked about the 1970s and the lesson that we learned there, but then you saw a bid into the bond market, which tells me that was interpreted as dovish. If what you see for the ECB and the Fed comes true, what does the BOE do?
Yeah, I mean, the risk is that BOE will also have to hike more than what's being priced into the market. We think that 425, 450, that sort of range is where they head to for now, but the risk is both with inflation and with rates that they have to do more. Remember that Bailey and the BOE in general has been more dovish than Schnabel and ECB, and certainly than Powell and the Fed. And that's because they are very concerned about the housing market out here. I mean, this is not 30-year mortgages, this is 2-year mortgages, and as that rolls over, it's going to have you're going to have a big problem in the economy, and so therefore their willingness to push rates much higher is amongst all central banks, bar the BOJ, I think is the least. So I think there's a possibility that the curve stays reasonably steep here.
Okay, we're going to leave it here. We're going to come back in a second. Zoe, thank you very much. Really appreciate it. Zoe Snaways, Western Europe Economy Reporter, editor, I should say. Thank you very much. Banu Buweja, UBS Chief Strategist, stays with us. He sees Euro Stoxx 600 dipping to 410 and the S&P going to 3,200 before bottoming some more in that call next. Speaking of, we're 2 points away from the 200-day moving average for the S&P. We're at 39.41. If we break through that, you can make the argument that we're going to see some more momentum selling there. The Nasdaq is the lows of the session, off by over 1%. That's also dragging European stocks lower. Euro Stoxx 600 extending its drop to a session low of 0.7%. This is Bloomberg.
gasoline season continues.
The chips are down.
Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
Feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's the most valuable company.
Trending towards the higher end of its historical range.
That can continue.
How do I play this into 2023?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
"16 minutes past the hour. We're back with Bonnie Buwaja, UBS's chief strategist. He says that equities both in Europe and in the United States are still going to bottom out maybe in the second quarter. He sees the stock 600 dipping to around 410, the S&P going down to 3,200. Bonnie, it's been a roller coaster this year. What gets us to those numbers?
Yeah, so look, I mean, let's start by looking back very briefly. So the first trade this year was the Goldilocks trade, when inflation came off and growth didn't, and people basically short covered. Since February, we have been worrying about inflation and higher rates. What I think lies ahead is inflation comes off slowly, but growth turns much, much lower. So starting Q2, I think we'll begin to see these Q1 numbers. Basically, March onwards, we're going to see the labor market beginning to weaken. We're going to see the consumer beginning to weaken, margins coming under pressure, and that's what leads the market higher. What I will concede is that between now and then, you could have a month or two where the data stays reasonably firm.
Mm-hmm.
What I do feel reasonably confident about is through this time, you're not going to see the market melt up. There isn't the fuel of shorts out there that can lead to a melt up because of the covering. That trade's already done. So I think at best, you get a grind up in the market, but everything in credit spreads, in skew, in correlations is telling us that this is a good time to buy protection, even if the actual downturn begins in Q2 and Q3. But we do think that Q2 would be the time when earnings come down, credit spreads move out, valuations come down, and that's what's going to take the S&P to sort of sub 3,500.
Banu, why Q2? Because the scenario that you're laying out, everyone kind of thought was going to happen in the first quarter. Like, this is the scenario that we were all talking about in the fourth quarter of last year. So why Q2? What is there a trigger? Is it just a normal meltdown? What happens?
No, well, this is normal lags of monetary policy. It takes somewhere between 12 to 16 months for that to feed through, and that's the time we have been tightening. But also because if you look at the savings rates in the U.S., they've been so low, the flow of savings has been so low, and the stock of savings begins to get exhausted. So for the bottom 50% of the population, the stock of excess savings pretty much goes to zero, and for the entire population, the stock of excess savings goes to zero in Q3. So the actual recessionary data can probably begin in Q3, but the markets, remember, always react before that. So the kind of upticks that we have seen in retail sales and core PCE spending, which by the way on a 3-month basis is flat because November and December was so poor, January was a little bit of give back from that. We think these numbers begin to come off again March onwards, and that's going to be reflected in Q2 numbers. It's going to be reflected in April, and that's when the earnings downsides also begin.
Let's talk about some things that may rescue the market. China, Japan, both still pushing the credit impulse. Liquidity helps, definitely in equity markets. China's economy is coming back. The data, the PMI data today, certainly reflecting that. Are there factors that are going to lean against the narrative that you're talking about?
So it's not clear how fungible that liquidity is, because although the Bank of Japan's balance sheet is still expanding, and if I just look at a sum of all central banks' balance sheets across the world, they're actually growing because of the Bank of Japan. Yep. But if you look at Japanese investment abroad, that's actually been coming off. Right, so if you look at, they're not buying U.S. treasuries, they're not buying, but so it's not clear that it's fungible. The China point is a much more potent point. However, I would argue that this time the entire delta in Chinese growth is consumption. And European cap goods or Aussie mining or South African coal does not feed China consumption. It feeds China investment, where we are not expecting any renaissance. So the way to play China is through China. And the market disagrees. The market completely disagrees. This year, Euro stocks are up 8%. Yep. China is actually down till today. I think the opposite trade is true, that in the near term, we want to be thinking 8 shares and A shares, even more than 8 shares. We want to be thinking...
What about LVMH? What about luck?
They have already rallied, and I think that particular stock can do quite well. We're still quite bullish on that, but that doesn't move the needle for the entire market, right? So what's necessary out there is whether industrials do well and whether cap goods do well, miners do well. They are doing extremely well, except we don't think that love should come from China, because we're not expecting a property rebound and we're not expecting a manufacturing rebound. China, you play through China.
Banu, what do you do with bonds? Do you get into it before the downturn hits in the second quarter?
I think so. I think this is a good level to start going back into bonds again. I mean, they had moved quite strongly, but we think that there's about 100 basis points rally this year. I think it's a little bit early to get into the 2-year. You do need to see weakness in the U.S. labor market before the 2-year can come off, and we think that's a Q2 phenomenon. But starting Q2, I think 2-year is going to be the best trade in the year, and I think you're going to see a bull steepener, as folks call it, in the fixed income market. Just a little bit early for that. We would stick to the 5s and the 10s in the U.S. right now. So yes, long bonds. And if you look at the equity risk premium, it's very limited, i.e. bonds are cheaper than equities are. So if there's cash on the sidelines, I think it's going to be allocated to bonds before it's going to be allocated.
This is the question we were asking earlier. Does the cash on the side, because the equity market thinks that cash is its, i.e. it belongs, that cash on the sidelines is going to support the equity market.
Yeah.
The question is, does the money on the sideline actually belong to the bond market?
It does, because it's come from the bond market. Because the bulk of the selling and the reason cash levels actually went up was because levels of bond holdings came down, and I think it's going to go back into the bond market. So the US is where we would go into bonds, Korea is where we'd go into bonds, Australia is where we'd go into bonds. Europe, difficult situation for the ECB, really difficult situation, so we'd wait before we buy bonds. But other markets like the US and parts of Asia Pac, I think it's time to go long duration already.
Hey, Banu, where are you wrong? Where's the biggest case where you could be wrong?
Look, the first is if we see a decline in the oil price in a very good world. So for instance, if we do see ceasefire, number one, and number two, as a result of that, Russia increases its supply of energy to the rest of the world, then you can get an elegant landing and the cycle can continue. You see disinflation and you see the beginning of a new cycle. So that's where I could be wrong. That's one thing. The other place where I could be wrong for a little while, for 3 to 6 months, is that contrary to what we are saying, China's demand is actually import intensive. It does make demands on the rest of the world. So you get about a 3 to 6 month spell where Chinese investment lifts because of the massive credit impulse that could come through into the economy. So it's not just a China trade, it also becomes a Europe trade. These are two places where I could be wrong. But what I worry most about in our investment recommendations, obviously as a citizen I hope for that more than anything else, is that if the war gives over and you see oil prices going to 60 in a good world, that's the beginning of a new cycle.
It's always great to catch up. So thoughtful. Thank you very much indeed.
Thanks, Guy.
Banu Baweja, UBS's chief strategist. Thank you very much indeed. This is Bloomberg. European stocks are nosing over right now. We're down at session lows. It's been happening over the last few minutes, but we've still got a whole bunch of 52-week highs in the market that I think are worth dwelling on for a moment. Stellantis is the car company, is at a 52-week high. We're up by over 3%. Whole bunch of reasons behind this. The numbers were good recently. They've got management changes. Take a look at French car sales today, actually fairly good. So this stock has been on a tear. Take a look at what's happening with the credit, though, on that story. I think it's an interesting one. ABF, the Western Family's vehicle. You've got it up a little bit today. The owner of Primark, of course, 52-week high. Man's at a 52-week high. Moncler after its numbers at a